To anticipate one thing, in our main scenario we continue to expect a shorter war lasting only a few weeks and accordingly no long blockade of the Strait of Hormuz. This argues against an oil price of $100 and beyond, as do the relatively high global inventories. In the event of a shorter war, the Eurozone economy would not be significantly affected. We would then stick to our forecast that the dollar will continue to depreciate because Trump is eroding the independence of the Fed. Nevertheless, a longer war lasting several months cannot be ruled out. This is because the war has spread to many countries. In addition, Trump wants to overthrow the Mullah regime, which is very resilient. In the event of a prolonged closure of the Strait of Hormuz, the oil price would probably rise to at least $100. If the oil price remained at this level for several months, inflation in the Eurozone would rise from the current 1.9% to a good 3% in the coming months. This is mainly due to massively higher prices for fuel and heating oil. In addition, households would have to pay significantly more for new gas supply contracts. The price of gas traded at the exchange has risen significantly more than the oil price. In addition, energy is an input for many other goods, which would also become more expensive over time. All in all, a prolonged war would trigger a renewed surge in inflation. In the Eurozone, an oil price of $100 would also have a significant impact on the economy. First, significantly higher inflation would weaken consumer purchasing power and corporate profit. Secondly, a prolonged war would increase uncertainty, which would be negative for corporate investment. All in all, we estimate Eurozone economic growth to fall by 0.4 percentage points in this risk scenario. That would be painful given that the Eurozone economy is only growing at around 1% on a long-term average. As far as the ECB is concerned, it would probably look through an oil price-induced rise in inflation. Ultimately, the poor economic outlook would prevent rate hikes. US and German government bond yields have already risen significantly. This is because many investors fear higher inflation due to rising energy prices. In the risk scenario of a prolonged war, this pattern would continue and yields would likely rise further. The dollar would continue to appreciate because, as the world's reserve currency, it typically benefits from increased uncertainty.